Hi, I'm Scott Schulte, the cow guy here for Traders Exclusive in London at the CME Group. It's been a busy week. I did a half hour on CNBC this morning. I've been on Fox twice. I did a BBC show last Tuesday night. And you know what we're all talking about? We're talking about the tariffs, the trade talks with China. That's a big one. We're talking about interest rates in the States. We've talked about the Fed. So there's a ton on our plates, and watch that dollar get stronger. It's been very, very interesting and a very, very interesting time. The dollar has come off from 15-year highs last year or 2016, and it got hit pretty hard. It was a fairly precipitous fall. It's come back a little bit. Do I think it's going to run away from us? No, not really. It held that 90 level in the Bloomberg DXY index. But what I'd like to really focus on is this. We've got a market that's just not getting a bang for the buck. And what I said this morning on television is that I think that there's a leak in our economic system, right? 4.1% unemployment, but we can't get wages to really take off. We've got a GDP that really can't make it to 3%. So we've got tax cuts that are supposed to be eking their way through the system and an infrastructure spending bill. And we've got less regulation. Let's get going. What's the problem? It seems like something's leaking out of the engine before we get to where we need to be with that real true growth. And I think it's probably a number of things, but the top four things I think that are leaking out of our engine are: number one is I think that 10-year yield going above 3%, interest rates do matter. Number two is interest rates in general. We've had the short-term rates start to compete with dividend-yielding stocks. So we've got a 10-year yield over 3%. We've got the shorter-term guaranteed government money paper that's yielding over 2%, say for 1 year. So that's going to suck some money out of the equity market because it's going to take away from those dividend-yielding plays. I think we've also got volatility, which we haven't had before. All right, so volatility, interest rates, a 10-year, and $3 a gallon gas. That could be something we see this summer. So a lot of things are a little bit negative on that market, and that's not giving us that leg higher or that whoosh higher that we'd like to see when we've got great earnings coming through like we have done this last quarter. So good earnings and disappointment, no bang for your buck. And it's because of those four things I mentioned. $3 gas, 3% 10-year, interest rates in general, even the short-term ones higher, and we've got a lot of volatility. So these valuations are going to struggle to really take off from here. That's been keeping the market down. So I hopefully made that simple, but those are the four reasons I think that we've got our engine leaking. We need to, kind of tape those things up before we can really start taking off and put in some good quarter-mile times. I'm Scott Schulte here for Traders Exclusive in London. I'll see you again next week.